All right, hello everybody. This is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. We have seen a pretty massive market rally this week. It's been one of the biggest 5-day moves to the upside that we've seen in a long time. It's been impressive to say the least. As a result, we've got a market that is incredibly overbought in the near term. Now, what does that mean for us? Number one, could this market continue to head higher? It could. I'm going to show you why in just a second. I don't believe that it's going to continue at the pace that we've seen so far this week. We could also see a period of consolidation. We could also see a reversal. There's a lot of different scenarios that could come into play over the next few weeks. From a bigger picture perspective, we're going into the summer months where historically it just tends to be a slower stretch. Things tend to take longer to develop. A lot of times we get lower volume moves. You start to see slower sessions intraday where there's not much going on. And then as a result, it can become more difficult just to buy outright calls and puts because the time decay is hurting those types of positions. Well, let's talk through something else that we can do to increase our odds of success. My outlook, because of the last 5 days, is that this market is near a point where we could start to see a slowdown. We could start to see some consolidation, maybe even a reversal. And one of the names that I was looking at was AMD. This is Advanced Micro Devices. Over the last couple of weeks, we have seen a move from 26 all the way up to 32. Pretty impressive move, right? And when you start to talk about a 10, 15, 20% move in one direction, that's impressive. Doesn't mean that the top is in, doesn't mean I'm trying to pick a market top here, but what it does mean is that on all likelihood, we're going to see things start to slow down. The pace that we've seen on the upside is not sustainable, and here's why I know that. Take a look at the histograms that I've got down at the bottom of the chart, specifically that red and yellow histogram. It's what we call our pulse indicator. Notice on the right-hand side, the last 4 bars are showing up as yellow. Those indicate that we're between a 1 and a 2 standard deviation move on the upside. We're overbought here. What does that mean? 1 to 2 standard deviation move to the upside. What does that mean? Well, when you start to take a look at statistics and you're taking a look at the likelihood of an event happening, when you start to get to an extreme like this, in all likelihood, you're probably going to see a slowdown. When I start to see 3 out of the past 5 bars showing up as yellow, in this case we've got the last 4, it indicates that we've already seen a nice move to the upside. And the chances of us moving higher from here are slim. They're not zero. It could happen. But if I want to put a trade on where the odds are in my favor and I can start to stack the deck in my favor, I would rather lean a little neutral to bearish here, expecting a period of consolidation, expecting a potential pullback, and I want to put on a trade that would allow me to make money in that type of environment. If all I did is come in and buy a long put here, the only way I make money is if that stock makes a big move to the downside and it happens quickly. I'm not willing to take that approach yet. Price action has not confirmed that we're ready to reverse. The reason I don't need price action to confirm when I sell a credit spread is, as you'll see in a moment, I've got 5 different ways of making money on the trade. I'm actually putting time decay in my favor. Every day that passes, I get to make money from that time decay. So I'm going to show you that how that works here in just a second. So the basis for this trade is the overbought condition, the yellow bars on my pulse indicator indicating that we're at an overbought extreme, and I want to put on a position that would benefit from either a move sideways, a move lower, and I can still be okay if I get a slight move higher. The only move that would hurt me with this trade that we're going to talk about in a moment is a big move higher from here, which I'm not expecting because the market's already overbought. So let's jump over to the trade page and let's go to AMD. And I pulled up the July 5th weekly options. Those are the options with 28 days left to expiration. A lot of times with these types of positions, I look for between 20 and 40 days left expiration. That's kind of the sweet spot that I typically look for. Now, what I did is I went to the out of the money calls, and I went to the 33.5 call. It's almost $1.50 out of the money here. And the price of the stock is currently sitting just above 32. If I right click on the 33.5 call, I'm going to go to sell and I'm going to select vertical. That's going to pop up an order down at the bottom. By default, I'm selling the 33.5 call, and it has me buying the 34 call. I don't want to buy the 34 call. I'm going to stretch this out. I'm going to click on the drop-down menu, and I'm going to buy the 35 call. Reason being, I want to collect a little bit more premium there, give myself a little bit more profit potential, and also I want a better risk to reward ratio. This order here where I'm selling the 33.5 call, I'm buying the 35 call to make it a risk-defined trade. It's currently trading for 45 cents mid-price. If I click on the confirm and send button, the order confirmation box comes up and you can see that I would be risking $105 to make 45. I'm right around risk 2 to make 1, which at initial glance, some of you might be saying, I don't like that ratio. I love it. And here's why. I have 5 different ways of making money on this trade. In the confirmation box, you can see that my break-even point would be at $33.95. The current price of the stock's at $32.14. This is a neutral to bearish trade. Ideally, I would love to have AMD pull back, but it doesn't have to. It just needs to stay below $33.95. I've almost got a $2 cushion here where I can be dead wrong and still be okay. I can still make money. The only move that hurts me is a move up above $33.95. So if the stock moves up slightly, I'm okay. If it moves sideways, I'm okay. Any type of a move to the downside, just a drift lower, a complete breakdown to the downside, I'm okay there as well. So I have 3 ways directionally that I can make money on the trade. I also make money if time decay adds up and if volatility decreases. So it does give me 5 full ways of making money on the trade. As a result, I'm going to have a much higher winning percentage. That's why I'm willing to risk 2 to make 1. I can make the numbers work long term if I keep my risk to reward right around 2 to 1. I can't make it work if I start to risk 5 or 6 to make 1. That doesn't make sense. So in this case, I'm willing to risk more to make less within reason. We're going to keep it at risk 2 to make 1. The 45 cents or the $45 per spread is the most I can make on the trade, regardless of what happens. If this thing completely falls out of bed over the next few weeks, the most I can make is $45 per spread, which at initial glance, you're saying, man, that just doesn't really look like a large profit. But you've got to remember, I'm only tying up $105 of capital to begin with. It's a very reasonable cost regardless of account size. If you do have a bigger account size, you can put it on 5, 10, 15, 20 times. You put it on 10 times and you still only have $1,000 of risk. And now all of a sudden you've got $450 of profit potential, which is great considering this stock has to do absolutely nothing. If it moves straight sideways, I can still make money. That's a great scenario, knowing that we're going into a historically slow time of the year for the markets. A lot to like about this trade. Now, it doesn't mean I'm opposed to buying calls and puts. That's something that we do with our students all the time. I just want to make sure that that matches up with my outlook for the market. I do not want to buy a long put here because I only have one way of making money on that trade. The stock would have to move lower quickly. In this case, I still am able to put on a trade that matches my outlook. It matches my neutral to bearish outlook here over the next few weeks for the entire market. Ties up far less capital, gives me more ways of making money on the trade, which in turn is going to give me the higher winning percentage. That's why I love this type of a trade. Now, we teach our students all the time, do not fall in love with one strategy. Would I do credit spreads all the time? No, I wouldn't. They're great. I love to use them, but it's only one piece to the puzzle. There are certainly going to be times that I like to buy calls and puts, and there's times that I like to buy debit spreads. It just depends on what the market's giving me. If we give ourselves the flexibility to use different types of option strategies, you're not going to be so stressed looking for one specific type of market. I don't care what the market does. If it moves up, down, sideways, if it's volatile, if it's slow, it doesn't matter. By having a mix of different option strategies at my disposal, I can take what the market's giving me, and that's going to give me better consistency in my returns over time. Now, if we collect $45 per spread here, how do I manage the trade? Where's my profit target? I like to target between 50 and 75% of whatever I collect to put the trade on. So if I'm collecting $45 per spread or 45 cents per spread, I would love to buy this thing back for between 11 and 22 cents. I would place my order initially to buy it back for 11 cents. So at any point over the next few weeks, if I can buy it back for 11 cents, the order's already working, I'm good to go. It would fill and I would book my profit. So it's a very hands-off approach with this style of trade. If the trade goes against me, if we are dead wrong and the market continues to just plow its way to the upside, I reevaluate the trade when I am down 50%. So I'm risking $105 per spread here. If I'm down 50%, I would consider taking the trade off, just waving the white flag saying, hey, I was wrong on this trade. Let's keep the risk small. Let's move on to the next trade. Right, so that's how we'll manage it. And we'll continue to track it here over the next few weeks in our upcoming Trade of the Week videos. If you have any questions, if you decide to put this trade on, you want to know, hey, how do I manage it? What do I do here going forward? Feel free to post a message here inside of the blog. You can post a message on the YouTube video, or you can email me directly. My email is mike@netpicks.com. All right, so we'll track it here over the next few weeks, see what happens, and we'll go from there. So enjoy your weekend, everybody. And we'll talk to you here next week for our next Trade of the Week.